Hello and welcome. This is the Insurance Pro Blog Podcast. Episode 447 has arrived. I am Brandon Roberts.
And I am Brantley Woodley.
And you are listening to the internet's favorite podcast about life insurance.
A long and distinguished list.
Hey, that's my line. That's your line. We did it. Good.
Now we can move on.
And I guess we've now transitioned into the two middle-aged men complain about the insurance industry podcast.
Yeah, that's right. You're officially middle-aged.
I've arrived to the club. So somewhat disappointed by the lack of corduroy overcoats and Werthers.
I know. Where are your elbow patches?
Coming to greet me, but you know.
I'm going to have to send you a tweed jacket with some leather elbow patches and a pipe.
I will wear it lovingly forever.
Well, you actually live in a climate where you can pull off tweed. I had a tweed jacket. I wore it like 3 times in 12 years, I think.
The air conditioning's got to be running mighty high in order for that to make sense.
Ooh. Yeah.
So today, we're getting a little more philosophical about things.
Ooh. That sounds promising.
Yeah, we want to talk about kind of financial planning theory here.
Yes.
By I was going to say attacking, but that's not really right. By sort of addressing what I think a lot of people use as their default retirement plan.
Yeah.
And I don't mean plan like you've got this account plan and that account plan. I mean their plan. Like what's their strategy?
Right.
And what happens with this is a lot of people make some really bad default assumptions or decisions that I don't even think they really understand they're making in most cases.
Yep.
But they do it and they don't really realize until many, many, many years later when it's really too late what exactly they signed on to.
Yep.
And it creates a little bit of frustration for a number of people that doesn't have to work out that way.
I would say it's even worse than that.
Okay.
In that many people never realize that they should be frustrated.
Okay.
They find themselves sort of trapped and they don't really know why they're trapped, but they're frustrated about their circumstances, but they never connect the dots as to there's a different way to approach this than the way that you approached it.
So a lot of my frustrations were my own doing.
Well, such is life. I mean, no one's immune from that, myself included.
But I feel like because the as you say what you just said, there's sort of a typical trope that forms in my mind.
Okay.
Like the let's say late 50s-year-old, generally semi-professionally or professionally employed individual who's been doing roughly the same thing for a couple of decades.
Mm-hmm.
Their enjoyment with it has declined over the years.
Yeah.
Generally speaking, there's kind of an event around this point in their life that has pushed the enjoyment even further down.
Yeah.
Could be their boss changed. Could be there's some sort of company policy that just doesn't work for them that great. And it's accelerating their desire to be done doing what they're doing.
Correct.
The problem that they face is...
This is a story we've heard dozens of times.
Yeah.
So,
the problem that they face is they have all of their retirement money concentrated in one specific place.
Right.
And it severely limits their options with regards to what they can do.
Right.
To retire, or maybe even change their job and not do what they're currently doing. Accepting that they would get paid differently, but by which I mean less, which would let them do other things, which if they had made other decisions about their money ahead of time, maybe those options wouldn't be so difficult to execute on.
Yep.
So, we're going to use the word 401k a lot here, but there are other accounts that would operate similarly.
Well, I would say over concentrating on any one thing.
Yeah.
Is going to hold that same. We simply used 401k as a placeholder here, basically.
Except for life insurance, because life insurance is infinitely great, and you should just buy it as much of that as possible.
401k is sort of a placeholder here in the sense that I think it's the most ubiquitous way that people prepare, quote unquote, for retirement.
Yeah. So fundamentally,
it's not that we hate the 401k before we get all the hate mail and comments, and we don't hate the 401k. We don't think it's the worst thing ever.
No, they work. We've met plenty of people who have amassed millions of dollars inside their 401k.
Yep.
Sadly, there are some of them that feel kind of trapped by it, and we're going to kind of
sadly, there's even more that are trapped that may not realize they are.
Mm-hmm. Mm-hmm. Fundamentally, I think a lot of people default to this assumption that, okay, I've auto-enrolled in my 401k.
Yep.
Which means there's a certain amount of money that's going to get put in my 401k every time I get paid.
Yep.
And that's my plan.
Sure.
Like, checked off the box. We're good to go. Don't have to worry about this until I'm 65.
Right.
Or whatever the magic age is.
Right.
And the issue that creates is that it lulls you into the sense of false security.
Mm-hmm.
Because you don't actually have a plan. Like, there's a lot of things that are going to happen between now and the time you retire that are going to test your will in many different ways.
Right.
And your lack of preparation for that could very much be your undoing.
Right.
Because all you did was say, all right, certain amount of money is going into the 401k or whatever it is, and I'm good. Plan's done.
Right.
So when people decide the 401k or similar retirement plan is it, they really are trading control for this idea that they've created some sort of safety because they're planning, right?
Yeah. Yeah.
And there's a lot of control that you give up when you concentrate wealth building in a plan like that to the degree that most people do.
Yeah. That's an important distinction.
Oh, yeah.
That you made, to the degree that most people do.
Yeah.
Because further on the spectrum here, many of the people that you and I have talked to over the years, they're not just doing whatever the auto enrollment, that you described.
Mm-hmm.
They're fully dedicated. They're putting many thousands of dollars a year.
We've met a lot who max it out.
Yeah. Yep. And they may not from day one, but as their careers progressed and they were able to, and et cetera, right?
Mm-hmm.
They had more discretionary income.
Yep.
So they redirected more of it to their 401k. And they end up very, I'm going to say, lopsided in their, in what you would be. This is an interesting conundrum because I disagree with this, but I'm going to use the term because this is the way the industry views it and the way that bankers would view it from a balance sheet perspective or personal financial statement perspective. They end up very lopsided in their liquid assets, skewed very heavily towards 401k, rollover IRA, what have you, right? Like, lots of money that you can't touch without a pretty substantial penalty until you're at least 59 and a half.
Mm-hmm.
I guess I just sort of lump it all into the same category.
Okay.
And so that doesn't leave them a lot of flexibility and options for, I'm 52 and I've been working at this job for the past 25 years and I've really begun to loathe it.
Yeah.
And what I'd really like to do is, X, Y, or Z, start my own company, do this or that or the other. And I've got $1 million or a couple $1 million, but it's all locked up in a 401k.
Yep.
So that's a very common, that's not even a trope. That's just a common theme.
So I have a question. You made a really great point, but you prefaced all that with you disagree. What do you disagree with?
I disagree. Well, I'm trying to remember what exactly I disagree with. I disagree with so many things, Brandon.
Okay.
I can't remember the point I was
unimportant.
trying to make,
You apparently
but,
don't disagree with the point that you made, so we'll stick with it.
I agree with the point that I made. Obviously, I just disagree with the concept that this is a all you need to be concerned about.
Okay.
I don't think that was the point I was going to make, but I definitely disagree with that too. So.
Okay. So the idea is when you have hyper concentrated yourself inside your 401k or similar plan,
mm-hmm.
you've really, really locked yourself into a very small corner.
Yeah.
And those are decisions that you make, maybe not in their entirety when you're younger, but you start down this path of decision making that makes you more and more committed as time goes on.
Right.
And it's not until you get to, in our example, this late 50s time frame, that you realize, I wish I could talk to a younger version of myself and say, stop that.
Right.
Because now there's a certain number of other decisions that the door has closed basically on
mm-hmm.
because of what I chose to do.
Right.
Sort of sequentially up to this point.
Yes. I think what I was going to say was that I disagree that it's liquid.
Okay.
Because I mean, technically it is. I agree with, I get that, but it's liquid with handcuffs. It's liquidity with handcuffs. All sorts of handcuffs.
Well, I think that begs a very interesting question. Like liquidity would suggest that you have access to it.
Right.
Like,
if you're still working a job and you have $1 million in your 401k, you do not have access to it.
Right. In the world of banking, if you're a student of banking, you sort of learn that a checking account is very liquid. A savings account is slightly less liquid, though they don't usually have the restrictions that they had years ago. And then CDs are considered illiquid, even though the quote unquote penalty for touching the money in a CD really isn't that harsh.
Right.
So the idea there is that CDs are not liquid because you have to hold them through their time frame in order to receive the interest that was promised.
Right.
That is far, far less a negative consequence forfeiting the interest.
Yes.
Than pulling money out of a 401k account.
Right.
Like far less.
Mm-hmm.
And yet we do refer to 401ks as liquid net worth when they aren't, and they aren't for a couple different reasons. I mean, there's an age restriction.
Yeah.
And that sometimes gets justified as well. It's there to create good behavior, because if you start pulling money out younger, you might run out. Okay, right. Fine. I don't necessarily think that's accurate in a lot of respects, but fine. Let's just accept that one. But then there's also the issue of liquidity when it comes to the notion that for most plans, you can't take money out if you're still employed.
Right.
Like we've met a lot of people along our travels who have a lot of money in their 401k, and they would love to do other things with that money. And it's not buy life insurance. Like it doesn't have to be that.
No.
But they can't do those things because they're still employed.
Right.
And they can't take the money out of the 401k. Like their options are quit so that you can do a rollover to an IRA. Then you might open the door to these other options. But if you don't want to quit, then you can't do any of those things.
Right.
So the idea that it's liquid or flagged as liquid net worth is a bit silly, because it's not. You are locked into the 401k. You're locked to the consequences of what taking money out looks like. And you are locked into the decisions that can be made inside the 401k. Now, there's the kid in the back who's smart, who's going to raise his hand and point out that there are a number of platforms now that are opening you up to a much broader selection of options when it comes to your 401k investments. And this is true, but it's not universal by any means yet.
You and I have not encountered it
very frequently. There's some, but not many.
We know it's out there, but it is not common. And there's someone else who will say, yeah, but you know, there are certain circumstances that you can take money out. Yes, you, excuse me, there are circumstances where you can, and every plan is slightly different in how it's set up and can have all sorts of provisions in it. In general, in our experience, accessing the money from your 401k while you're still working at the place where the 401k is comes along with, knee busting penalties.
Yeah.
And or costs, if you want to call them that.
the in-service withdrawal is kind of on the same level as the Easter Bunny and the Tooth Fairy.
By in-service withdrawal, you mean the ability to roll the money out to an IRA while you're still working.
Yes. So while you're still working,
we've been talked. It's one of our most common inside jokes that we make, because we were told for years by various sales reps from companies,
annuity wholesalers, a lot.
Yeah.
Take the in-service withdrawal.
What if I got an in-service withdrawal?
Yeah.
I haven't found one yet.
Yep.
I mean, I'm sure they're out there, but I've been doing this for 25 years. I've not run across one yet.
And well, I mean, there's lots of incentives to not advertise it, but we've even run into situations where people don't know if they have one. They reach out to HR and HR doesn't have a good answer on whether or not one exists. It isn't as widely a thing as people would like to think. Now, it makes perfect sense to eliminate some of the problems that we are addressing today. Have access to a certain percentage that you can take out and put in an IRA so that you can do other things.
It's not good business if you're in the business of writing 401k.
Well, there is that. There is no incentive to promote or add the in-service withdrawal to a plan. There is no doubt about that.
Yeah.
So what we find ends up happening in a lot of cases here is that people sort of delay their life until after at least 59 and a half, because that would be the first time that they don't have to worry about penalties.
Correct.
Yes, technically there's a way around some of that with a special distribution from IRAs, but it's not a simple process.
Right. And it's not common.
Like it's funny how I was led to believe a 72T distribution was just the magical answer. Like you just do this, you do the calculation and you're all good to go. And then I actually did one and found out that you're on your own when it comes to the accounting.
Right.
So you better keep good records. It's there, but it's not the answer to this issue. No. So what we mean by people are delaying is they concentrate so much wealth inside something like a 401k, and they have money, but because of the early withdrawal penalty, they don't necessarily have access to that cash until they get to the magical age of 59 and a half, because taking it out before that creates too much problem.
Right.
Or they don't have access to enough through something like a 72T distribution to actually do what they want to do.
Right.
There's kind of this forced paradigm here that says you will save as much money as possible, and you will do that until you reach something like at least your 60s, preferably your mid to late 60s, and then you'll stop working and you'll take all that money that you saved and you'll use it to provide for yourself.
Yeah.
But that's not really the way most people do it. Like, as much as we've created this idea that that's the way people live their lives, that's really not the way most people do it.
Right.
The average retirement age is late 50s, early 60s.
That's mind-boggling to me. But
a lot of people end up with a major career change that spurs a massive shift in income at some point in their life. Could be their 40s or their 50s. And those are times when some of that money might have been helpful. There are a lot of people who do continue to work. I don't remember the exact numbers off the top of my head, but it's close to 20% of retirees return to the workforce.
Mm-hmm.
Not always because they don't have money, by the way. Like, there's a large percentage of them who return to the workforce because they're just bored when they retire.
Right.
So this idea that you have to save and capitalize your ability to retire is not necessarily true. And there is definitely a trend. We're trying to label it a new trend, but it's really not. That looks something like people work for a while. They may pull back because they just decide to. Then they go back to the workforce, maybe doing what they were doing, maybe doing something else. But if you have money saved in accounts that aren't your 401k with all of the rules and restrictions of that, you have a lot more liberty to pursue those things.
Yes.
And
agreed. That
makes life a whole lot easier. And yes, this is the Insurance Prologue podcast. Life insurance is one of the ways that you could store that money and benefit from it, for sure. But it doesn't have to be life insurance. There are,
and that's never going to be all of it anyway.
Nope.
So.
Nope. So
yeah, that's why I set this up in the beginning. Is the 401k is sort of a placeholder here because it could apply to lots of different things. You just having too much of your money concentrated in one thing, in one structure, I should say, and it could definitely prove to be problematic.
Yep.
I mean, we've worked with people who owned companies over the years.
Yep.
And many times in a quote unquote small business, you'll find the vast majority of the owner's net worth is tied up in the business.
Yeah.
Which can be good, can be bad. I mean,
depends on when they sell the business and at what price.
Yeah. And as you and I know, most small businesses are not sellable.
Yeah.
Because they're dependent on a personality or a particular person who's the driving force, and there's no real systems in place such that another person could buy it and operate it and grow it. I mean, I'm not trying to be mean at all. That's just the reality.
But there's a same underpinning to the psychology or the strategy when it comes to that, as exists with this 401k-ish dilemma, right?
Yeah.
So like, I own a small business. My plan is I'm going to build the value of the business and sell it, and that's going to give me a bunch of wealth to just sit back and do what I want.
Right.
That's an idea, but unless you've got a really solid blueprint to get to that point, and you're going to intentionally build the business for its marketability, sellability, scalability, all those things that are going to be very significant to launching a business and having a good exit, which is totally the panacea in most people's eyes, but it's difficult to do. You need something else going on.
Yeah.
Like a plan B, just in case this thing doesn't become the wildly valuable business that you think it's going to become.
Right.
Or it's just not that sellable when you want to exit.
Right.
Because there's a number of things that might shift in terms of the world around you that would make what was a really good idea 10 years ago as a business become a much less attractive business now.
Yeah. So many examples of that.
Yeah. Yeah. So having other plans in place to build wealth. Again, life insurance is great. We like it, but it's not the only thing you could be doing with this. Right. We have long been advocates of building other sources of income through investment as one of the key ways to ensure you are set up to exit, if you will, whatever it is you got going on that you don't want to do anymore.
Keyword income.
Yeah.
I think we both agree that, if you really want to develop a solid exit strategy from the workforce, whether that be you own your own business or you work for a company, you need to begin with the end in mind.
Mm-hmm.
You need to begin your accumulation strategy based around how will this provide income in the future.
Mm-hmm.
What the 401k trap does is gets people to think about, how do I accumulate as much money as possible?
Yeah.
And that's it. That's the whole plan.
Yep.
And so then they get to the point where they've either had enough or they want to retire. And let's just say they are over 59 and a half and they can get access to it. And there's no penalties for doing so. Now they have to figure out, well, it doesn't really produce any income. So am I just going to spend this money until I don't have any money left, or what?
Yeah.
I'm not trying to be funny. I think I don't think that's how anyone would express it, but I do think that's what happens.
And we get asked this question every day.
Yeah.
Like, people show up with lots of money in a 401k.
Mm-hmm.
But they don't have any clear path to what they do to take this and create income with it, balanced with the other objective of it has to last for the rest of my life.
Right.
I actually don't view it as a difficult task. I think the answers are fairly simple. I also, though, know that people have a hard time sort of wrapping their head around the transitions that have to take place, the shifts that have to now come into play to get you from, we accumulated a bunch of money in your index fund that you were invested in your 401k to something else now that's going to create income.
Yep. I actually was listening to another podcast yesterday, and they made a point that I thought was so salient, and that was paradigm shifts are the hardest shifts to go through.
Yeah.
And that developing an income-focused mindset is a complete paradigm shift from accumulate as much money as I can in my retirement account.
Yep. Yeah, it does. It is. It is. I mean, you and I both, I believe, and I know very personally, I do, work with people on a regular basis who will constantly ask about account balance.
Right.
Like, how much money do I have? Or how much money did I make this week, month, whatever? And it's a very difficult thing to address because in the specific example I'm thinking about, those investments don't exist for accumulation.
Right.
Yes, account balances grow because there's income created in excess of what's being spent. So that part increases the balance. But the balance can also decline because there are investments that would decline in value. But we don't worry about that. We worry about the income that's generated on a month-by-month basis.
Right.
Because as long as that is a constant or increasing number, everything's good to go.
It's really no different a paradigm than what you're describing than when you were working. Mm-hmm. As long as you're spending less than we're making,
yep,
we're going to be okay.
But still to this day, that is a back and forth discussion because we haven't totally forsaken this obsession about the account balance.
Right.
Which won't do anything, doesn't mean anything, isn't an indicator of your ability to spend money, is simply a day-by-day mark-to-market of the shares that you own of things.
Yeah.
Which is a meaningless calculation.
I started doing this pretty regularly just because I wanted to amuse myself and sort of like prove to myself that this exists in every place, not just market. Most people think of stock market investments as being that thing, right?
Yeah.
But I started looking at the Zestimate on my home pretty regularly.
Yep.
It's the same thing, right?
Yeah.
It's just like, I mean, does that mean anything? Like, ultimately, I know this is very cliche, but ultimately my house is worth what someone's willing to pay for it on the day that I want to sell it.
Yep.
That's all that's relevant.
Yep.
In that scenario. And there's only one way for me to win, and that's for me to sell it for some amount higher than what I bought it for, minus all the money I spent while I lived here.
Mm-hmm.
Good luck with
Yeah.
it.
The only time I put real estate that I own in the ledger is when I'm trying to make myself feel better about net worth.
Right.
Because it doesn't really matter.
Well, I have to live here, so it doesn't.
Right. And for me, I get way more excited about the income that got generated last month from the things that I own.
Yeah.
That's a wildly more meaningful thing, number to look at.
Oh, that's money you can take to the grocery store.
Yeah.
And spend it. And you're not that concerned about spending it because it's like, well, next month some more's coming in.
Yeah. Yeah.
It's all good.
Mm-hmm. Now, there is one other piece to this that we haven't addressed that we should, and that is understanding tax implications to things.
Yeah.
And this is an area where a lot of people who are hyper concentrated in their 401k get really tripped up.
Mm-hmm.
Because they build all this money in their 401k.
Right.
And they do what everybody does. Maybe somewhere floating around out there in their mind, they are aware of the fact that this big balance is subject to income taxes. But they don't really want to internalize that because that makes the number look less impressive. So I have $2 million in my 401k. I have $2 million in my 401k.
Right.
The net after tax value, I don't want to think about that.
Right.
And then they start to use the money in their 401k for income. And they have to now start taking account of the distributions and the tax liability of those distributions. And sure, when they take a withdrawal, the company that holds the money probably has some sort of default withholding number for them. So when they go online and they say, hey, I want to pull $5,000 out, it tells them, well, all right, but after withholding, you're going to get this much. and they go,
Right.
oh, well, actually I need 5,000, so I need to increase that number, I guess. But do they know that withholding is enough? No, and they won't until April of next year comes around.
Right.
And the thing that makes that tricky,
until the IRS decides to start telling us how much we owe them instead of making us figure it out.
And the thing that makes that tricky is there are a number of variables that dictate what that number needs to be.
Sure, of course.
Like if you only pull $10,000 out of your 401k in a year, it's probably nothing. If you pull $120,000 out of your 401k in 1 year, it becomes a much larger number. And I don't mean it because $120,000 is larger than $10,000. I mean because the percentage of what you have as an actual tax liability has grown astronomically once you start increasing that withdrawal number.
Right.
And there's other things like now the taxability of your Social Security income that comes into play. Mm-hmm. So many variables that play into
increasing
this.
Your Medicare premiums.
Yep.
I mean, there's a lot of variables that come into that factor in.
So you have to have an understanding of this, or you need to choose things that have less to or zero income tax liability to them.
Right. Or at least less variability.
Yeah.
In what it could be that you owe.
Yeah.
Yeah.
Again, life insurance, good thing.
Sure.
Tax-free distributions. Well, I probably shouldn't say it that way. But effectively works that way. On top of a number of other things that you could be doing that have less or zero tax liability from a distribution standpoint. So these are the things.
And we're advocates that you should do all of those things.
Yes.
And it's not about you should, there's a lot of bad marketing material out there that's like, you should stop putting money in your 401k and buy life insurance. We are not advocates of that. We do not get behind that. That's not our.
Nor should you start taking penalties to withdraw money from your IRA to fund a life insurance policy or anything dumb like that. That's a bad idea.
Yeah.
Now let's do what we always do and wait till the very, very end to address the big question that everybody's been wondering, which is, well, how do I do this? And the answer that's going to greatly ungratify everybody is there isn't a singular answer here. Like the thing that I alluded to in the beginning is you got to have a plan. And now we get to this point where all of this stuff that we've talked about might sound good. And this is the point where we wrap it up and tell you have to sit down and figure out what the plan is.
Right.
That's what it comes out to.
And your plan's not going to look like anybody else's plan.
Nope.
That's the thing.
There's not.
That's why there's no prescription here.
But just zoomed out for a minute to give you a general idea, if the market goes down 20%, most people don't like that because they look at their balance and it goes down, and that's a really bad thing. But if your plan in terms of accumulation has involved things like income, then your account balance goes down by 20%, or maybe not that much because it's not 100% S&P 500, for example, but it goes down by some amount. But you still have all of the same income producing capacity that you did before.
Right.
So the loss in terms of value doesn't mean the same thing as the person who's 100% inside their 401k and 100% inside some sort of index ETF.
Right.
Because now, if that person wanted to start creating income with that, they got to sell shares to do it. And those shares are worth less than they were yesterday.
Right. I think a simple example is one that I, am in favor of. Let's just say that you bought a rental house, a rental property, and you paid $150,000 or $200,000, depending on where you live. I realize some people are listening to this going, oh, you can buy anything for less than $2 million where I live. Okay, I understand.
I was in Boston this weekend. I know.
Right. But let's just say you paid $150,000 for it, and you put 30% down. I'm just standard scenario here, right? And you're getting $1,500 a month in rent.
Yep.
And let's just say maybe over the next few years the neighborhood doesn't thrive. Let's put it that way. So now what?
Up and comer didn't up and come like the realtor said it would.
It came and went. So, instead of it being $150,000 house, now the comps in the neighborhood suggest that maybe it's more like $130,000. But it's 5 years later. Now you're getting $1,700 a month in rent. Do you panic? Because now the house is worth $20,000 less than what you paid for it if you had to sell it? Or do you just go, oh, happy day. I'm collecting $200 a month more than I was 5 years ago, so I'm good.
Yeah. And I took the depreciation on the purchase price originally, not the sale price now.
Right.
So.
But you get what I'm saying, like,
yep.
Because we know lots of people who are in the real estate game, never known any of them to panic sell on an income producing property.
No.
Because they don't really care.
Nope.
What difference does it make? So on paper, it's worth less money. Well, I would prefer that not happen, but ultimately, I'm still clearing, after expenses and whatever, $8,000 a year. So
yeah,
okay,
yep.
They can say what it's worth, whatever they want to.
So, just a sliver of this example says that if you have something like income to fall back on, then when things go badly, you're not freaked out.
Right.
Now, building on that even further, if you have a more complete plan, when things go badly, you're ready for those moments.
Sure.
It's not a panic sell, get me out of the market, I can't lose any more money, what have I done? Oh, it's none of that. But that's what people tend to do because they default this assumption that the 401k auto-enrollment is their plan.
Right.
And they feel really, really good about themselves when they log in and they find out that the account's up way more money than they thought it was going to be this past month.
Right.
But then they get horribly depressed when the news guy says things are bad and the economy is turning down and they look at their account and now it's dropped.
Yep. We saw that in our own lives in 2022, did we not?
Yep. And earlier this year.
Yeah.
It happens. But if you are planning for these things, not in the sense that, I'm planning for downturns, but just you have a plan for the bumps in the road.
Yeah.
These things become less problematic. You have a much clearer mind when you're facing these issues. And it stops you from doing desperate things in moments that probably aren't that desperate, because usually volatility can be scary, but it's relatively short-lived.
Right. Absolutely.
That's probably good enough for today.
That's far good enough.
Okay. So I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.